6,400. The breakdown of that is a 21 multiple. So
you're staying with that?
Yeah, staying with that. And it's a down multiple. It's a 21 multiple from where we are today at around 21.7. And earnings growth of 12%. So, unless we see cracks in that, I think, in terms of the earnings standpoint, we feel comfortable with that outlook.
Price action within the market, technology obviously upset. What's your view?
I mean, it's a momentum unwind to a certain extent. And I think this is what happens when valuations are too high, right? Like, this is what happens. It's expectations get higher and higher. And even if they're met to a certain extent, it's like, what's the runway for growth going forward? And this is just, to us, like somewhat of a healthy pullback in terms of technology. And I think it's being felt more broadly because this is what people own. But this is a good call, thinking about diversifying outside of that.
Are you separating the mega caps from some of the other high growth names that have seen an even bigger pullback than the larger cap ones?
Yeah, I mean, because, with the previous guest was just talking about the real cash flows. People are going to look for quality. These companies are quality. That hasn't changed. Whether or not the valuation reset is attractive enough for people to come back to them is, I think, the biggest question.
Yeah, I mean, we went through this, when the Fed started raising interest rates, all those non-profitable tech companies really had a big upset. Now, as we are worried about, growth and the valuations for those companies got too rich, we're seeing it again. It's good to catch up with you. Thanks for being here.
Thanks so much.
That's Abby Yoder of JP Morgan Private Bank. We do have more breaking news out of Washington at this moment. Megan Cassella is at the White House and has that for us. Megan?
Scott, President Trump has just signed an executive order that will put in place an additional 10% tariff on China that is set to take effect just after midnight tonight, bringing the total tariff rate on China that he has imposed so far in his term to 20%. Now, that has officially been signed as an executive order. An administration official was just giving me the details on that. And I did ask specifically, Scott, whether he had also signed anything on Canada or Mexico, and he has not done that yet. So even though the president just told me just earlier this hour that there is no room left for Canada and Mexico to make a deal, he has not yet signed the executive order putting that action into place, but he has now put that signature on the China executive order. That's set to take effect tonight, just after midnight, while we still wait and see what's going to happen next with Canada and Mexico. Scott?
Appreciate that update on the North Lawn. Megan, thank you. Megan Cassella of the White House. We're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli is here to break down these crucial moments of the trading day. Pippa Stevens joining us as well on energy and the sell-off there. Michael, I'll turn to you first. Well, we think we're getting the tariffs.
Yes.
As we are in the morning. 25 and 25 on Canada, Mexico. As Megan was just telling us, an additional 10 on China. That brings 20% the total there. And here's what you get in the market.
Yeah, so clearly, rough numbers, we had 2% of hope that we would not get the tariffs. I mean, was saying earlier today, it did seem like the market was going to eventually want to test the reality of that very late levitation we got on Friday. We've essentially unwound the entire thing, plus a few points. I do think a lot of it, though, just feeds all in the same direction, which is the economy having a stutter step, a little bit softer than we thought it was. Tariffs, therefore, seem like a kind of war of choice that's creating an exacerbating factor on the growth concerns. It's not causing an inflation panic, really. It's mostly about this is just going to kind of give us an extra little squeeze. Now, the unwind in big cap tech, I mean, the tariffs aren't going to affect Microsoft. It's down 2.5%. It's also about the stuff that was more heavily owned, more lazily owned. NVIDIA clearly is not allowing people to relax. And the fact that you had the dissipating dead cat bounces in Bitcoin and Tesla today gave, I think, a little bit of a tell on how the tape was. There is a sign at these levels of the S&P, you might get some acceleration to the downside, kind of going to the next likely stop, whether that's the 200-day or not. We're only talking 1% or 2% down from here is where people have been eyeballing those things. And obviously, two-year yield is telling you the same story under 4.
I mean, I like the word unwind. I mean, it's been an unwind of some of the mega cap money. It's been an unwind of the high valuation growth names. I don't know whether investors are ready to do an unwind of expectations for the months ahead and what they think is still going to be the prize that awaits Trump policy.
I think a lot of that is well underway, to be honest with you. I mean, I do think that, obviously the market is still only down 5% from a record high. It's about flat year to date. We're right in, by the way, the November 6th gap. Essentially, we closed the S&P 500 on election day, 57.23, okay? So we're talking about 2% from here. So it wouldn't take much to essentially say, okay, nothing more is priced in terms of policy goodies at this point. I really do think, though, the AI trade falling on its face is a big part of this. Since the Stargate OpenAI announcement, SoftBank, all that, NVIDIA is now 23%. Okay, everyone keeps throwing tens of billions of dollars at this theme, and the main beneficiaries are saying we're not confident we can capitalize those revenues at as high a rate as we thought before.
Well, certainly DeepSeek threw a wrench into the whole plan, and the market in many respects around AI hasn't recovered.
Which was basically the same day.
Since then, exactly. All right, Michael, thank you. I'll come back to you in a moment to Pippa Stevens now on energy for us. Pippa?
Yeah, Scott. Well, oil tumbled after OPEC announced it will increase production starting in April, taking the market by surprise to a certain extent, given how many have forecasted an oversupplied market this year. The group will gradually return 2.2 million barrels per day through 2026. And energy stocks following that move in oil lower, with upstream players like APA, Conoco, and Diamondback leading the declines, given that exposure to commodity prices. Now, clean energy also taking a hit. Residential installer Sonova plummeting 64%, now a penny stock, saying there's substantial doubt around its ability to continue operating. CEO John Berger adding the overall environment is, quote, terrible. Once a more than $5 billion company in 2021, it's lost 99% of its value. Scott?
Pippa, thank you. That's Pippa Stevens. We just saw, so Bitcoin's down a bunch.
Yeah.
Tesla was up initially, rolled over, I think, when we were on halftime.
Yeah.
Pointed that out. So a lot of these points, these pressure points on the market just won't cease.
Yeah, and ultimately that builds into this scenario where people have surrendered and they feel like there's no obvious place to hide, and the market's we're gonna wake up tomorrow and people are gonna say S&P finally looking oversold. It wasn't fully a washout because you actually still have the equal weight outperforming and you don't have 90% of volume to the downside, but you're kind of within hailing distance of a 200-day moving average test. Again, down 5% from the highs. It's been a pretty good reset of prices and psychology so far. So again, it leaves you open to this idea. If you get a reassuring jobs report on Friday, if we get the details of Canada-Mexico tariffs and it's not the bluntest instrument of 25% on everything, you know, there might be room a little bit for a little relief there. But there's no doubt about it that the market is telling you defense for now. It doesn't seem as if, it feels like we have to rewrite the script we had at the beginning of the year. And I think it was to some degree a lazy script to feel like it was going to be a great economy, a Fed moving quickly toward more easing, and policy accelerants on top of that. That seemed like it was probably too much to ask for, and now we stopped basically thinking it's likely.
I mean, look at the Russell, for example, which has just been a brutal trade. 6% down on the year. There is a look today near 3%, and it's down more than 7% within the last month.
The things to watch, in addition to some of those leading to the downside, like small caps, is the stuff that's held up better. So financials have kind of maintained their leadership position. Yes, they're down, but they've been more insulated. And related to that is credit conditions. It's eroded a little bit. Spreads have widened out a little bit on some of the riskier debt, not to the point where you'd say, uh-oh, it's game over. But with the VIX at 23, if credit is not going to weaken up very much, that's probably a net positive sign, but it's delicate here.
All right, it's going to be relief for many that the bell's about to ring, because it's going to ring out a pretty ugly day down here on Wall Street. We look ahead to those tariffs in the morning. We'll follow all that in the day ahead. I'll spend it in overtime with Morgan and John.
Well, that bell marks the end of regulation. EVI Industries ringing the closing bell at the New York Stock Exchange. AvePoint doing the honors at the NASDAQ. A sharp sell-off to start the week as tariff fears spook investors, with losses accelerating late in the session. A little bit of a bounce at the end after President Trump said tariffs will start tomorrow on Canada and Mexico. That's the scorecard on Wall Street, but winners stay late. Welcome to Closing Bell Overtime. I'm John Fort with Morgan Brennan.
We'll be all over this market sell-off throughout the show. Analyst Dan Ives will join us with his thoughts on NVIDIA's sharp intraday pullback and if there could be more pain ahead for shareholders.
Plus, we'll talk about the impact of tariffs on Tesla and the automakers with former Tesla president John McNeil.
And we'll look at the big drop for small caps when we're joined by Goldman's small cap portfolio manager.
Let's get straight to these messy markets. This late day sell-off after President Trump said tariffs on Canada and Mexico will indeed go into effect at midnight. Joining us is Wells Fargo Investment Institute Senior Global Market Strategist Samir Samana and iCapital Chief Investment Strategist Anastasia Amoroso. Guys, welcome. Anastasia, so on the S&P, can we show a 6-month chart? Because we're back near, I think, the Friday lows before that big rally. I mean, just the last trading day. Also happens to be near the 2025 lows from mid-January before a solid earnings season kicked off with the banks. And also right about near the pre-election highs. So my question is, with that in mind, it's not like these levels are brand new. What determines the trajectory from here?
Right. Well, John, I think if there's one silver lining about the current setup is that a lot is starting to be priced in. You know, clearly tariffs is a very disruptive thing to most everybody in the markets in various countries, but there's a point to where it becomes priced in. And when we talked about the Mexico tariffs and Canada tariffs and China tariffs first back a month ago, the calculation was that it's somewhere about a 5% downside that has to be priced into the market. Maybe it's because of market shrinkage, margin shrinkage that has to take place, and also valuation shrinkage as well. But guess what? We are down 5% from those 52-week highs, and we do have, it seems like, certainty of those tariffs going into effect. So with that, the valuations, the levels have been reset. And if you look at the investor sentiment, it is as bearish as we've actually seen it going back to 2022. If we look at the relative strength indicators, I think we're probably going to get hit oversold on a lot of those various stocks. So I do think this is a better setup now. And the bar for upside surprise of any sort is now a lot lower.
That sounds like a silver lining. With Samir, at the same time, there are growth concerns now that maybe there weren't before. I know you say we believe deregulation and tax cut extensions will help the economy more than targeted tariffs and immigration restrictions will hurt. That's what you guys are saying at Wells Fargo. But will they help as quickly as they might hurt?
Yeah, that's the key, John, is unfortunately from a sequencing standpoint, and we've said this for a while, the market just has not woken up to the fact that, you know, the Trump administration was going to tackle some of the market negative stuff first, which would include, immigration and was going to include tariffs. And you just saw this game of chicken. And to be fair, President Trump probably played a role in it by reversing the tariffs as quickly as he did on Colombia and then kicking the can down the road on the ones for Canada and Mexico. So he kind of played a part with respect to the markets maybe not taking him seriously. But now that we are here and the tariffs are going into effect, I think it's going to last a little while. And look, the market's got a little bit more positive seasonality into, April, but then you kind of hit the summer seasonals, which aren't as great. So I think, you could have a few more months of just sideways chop.
Anastasia, I want to get into the silver lining a little bit more, because what we have seen is a very defensive tone in the market. We've seen Treasury yields come off pretty dramatically here in the last, call it week and a half. You've seen real estate, consumer staples, healthcare, utilities, the more defensive sectors in the S&P outperforming. They actually finished in the green today. Are these, and equal weighted S&P did better than cap weighted. So we've been talking about the rotation even before we've gotten to this moment with tariffs and growth scare. Are these the places that you invest right now, or is this a head fake?
No, I think there are places to hide, and some of them which you mentioned. And by the way, completely agree with Samir that, the sequence is everything, and tariff threats were going to come before tax cuts. The most likely scenarios, the bars I mentioned is set lower. So maybe it's the Fed this month, maybe it's the payrolls report this month, maybe that's what kind of provides the markets with some stability. But I do agree that tariff threats are not about to go away. And in fact, they may be with us for quite some time, meaning the cyclical parts of the economy may be suffering for quite some time. And I say that because, Morgan, if we looked at the last instance that we had tariffs, and if you look at the manufacturing surveys, they were in this declining trend for about a year. I'm not saying we're going to get that, but let's say it's 3 or 6 months. In that case, even if we get a temporary pop in the market, I probably wouldn't step in and buy some of those cyclical sectors because of that precedent that we had before. However, what I would buy is I would look to the domestically oriented parts of the market, not only from the perspective of revenues, but also from the perspective of your cost of goods sold. What you don't want to be doing right now is importing your input costs from Mexico, Canada, China, and a whole lot of other places. So financials, real estate, healthcare, utilities, those are the sectors that stand out to us, even though they have held up better and arguably they're a little bit more expensive than beaten up tech.
Yeah, and you bring up a good point. And one of them being the fact that last time we saw tariffs, Samir, tariffs were much more surgically imposed here. And this is really widespread, pretty blanket across everything, whether you're looking at Canada or Mexico or another 10% on China and everything that's coming in across the border, at least right now as it stands as we look to midnight. But you look at global equities as well. I mean, we continue to see record highs in places like Europe, and that's in part because of defense spending, which we're going to talk about a little bit more later in the show. But do you look to other parts of the world which have been outperforming since the start of the year and invest there instead right now?
So probably not right now, because I mean, again, it's almost comical the fact that the market is somehow hiding in the areas that President Trump will absolutely go after next. So, I mean, I guess if you want to get whacked with all the moles, yeah, by all means, now would be a good time to go to international because that's where he will be moving next. But no, we would not. We would, if anything, be taking the recent strength to pull back on especially emerging markets. The one part of the tariffs that will probably be longest lasting will be the ones on China. And I would argue probably the second longest lasting are probably the ones on Europe. So no, we would be bringing money home. We would still favor U.S. large caps, but we are warming up to U.S. mid caps. With respect to sectors, I think financials are a pretty domestic story. I would argue comm services is the part of growth that actually has some reasonable valuations and a good use case for AI. So I think they'll be okay. Our dark horse picks are probably energy and industrials as those parts of the economy recover into the latter part of the year. But no, this would not be the time to go international.
Anastasia, back to sequencing. How long can investors wait for the good news part of this? What do the president and Congress have to deliver on regulation and taxes?
Right. Well, by the way, one of the headlines that crossed my phone, at least, is that maybe we are going to roll back some of the stringent regulations on large cap bank mergers. So I do think that this is all news all at once, and some of the deregulation is starting to work its way, through the system in the background. I also do know that the House and Senate is absolutely working on the tax cut bill. So I think as we move into the summer, maybe past some of the April deadlines that we have for tariffs, more and more of this focus is actually going to shift to taxes. And so, so that's why it's such a precarious situation for investors, is because you don't want to use tariffs as the reason to de-risk your positions massively. But at the same time, it might be too early to step in size, given that some of the tariff headwinds are still coming. So what I would do is I would really think about kind of reshifting the core of your portfolio. Maybe, if you haven't already, maybe it's too late, but maybe really refocusing on domestic stocks versus some of the internationally exposed tech stocks. And I think it's back to the yield story. One thing that maybe actually puts the bottom under this whole thing is if we see a more dovish Fed, and if we actually do end up with a rate cut or 2 or 3, as the market is now forecasting. So I think you want to look at some of the higher yielding assets. You want to look at real estate. I also think you may want to look at private credit as well.
All right, a lot to dig into right there. Anastasia Amoroso and Samir Samana, thanks for kicking off the hour with us. With all the major averages finishing lower, and the Russell 2000 the worst performer, and the NASDAQ composite as well, down 2.6%. Let's bring in Mike Santoli now for more on this pullback. Mike.
Yeah, Morgan, and sort of where it's brought us back to. I remember when prices go down, it also goes back in time. And John was mentioning we're basically into the election day levels, the area that was crossed by that November 6th rally, 2% above the 200-day moving average. There's nothing particularly magical about that level, except it is a pretty good intermediate long-term trend line. It's kind of the average price people have transacted at for most of the past year. The other thing I would point out is, if you talk about down 2% to the 200-day, this over here, the summertime high before you got the real gut check in Mag 7 is just under 5,700. So that was when growth stocks were finished carrying this market. So, pretty good, 6-7 month reset in prices often can be constructive if we're still in a bull market, if things don't fall apart completely in a macroeconomic sense. Take a look at growth versus value, because that's been one of the main dynamics, is big growth stocks giving up ground to value. Russell 1000 in both cases. Again, though, you see it kind of goes back and creates this sort of shelf. This is a 2-year chart. So still long-term growth has been advantaged, but you're really faltering in terms of that leadership. Did want to also point out the IPO index ETF has really given up even more ground. This is also a 2-year, kind of goes back to levels that you'll see right there at the beginning of last year. Everyone's talking about IPO calendar filling up. Hasn't really happened. These, of course, are older IPOs because there haven't been all that many, but they're kind of less seasoned, more untested companies, and it shows investors' risk appetite for taking a chance on them has declined a little bit in this whole general growth scare, guys.
How much do the technicals matter here? I mean, BTIG's Jonathan Krinsky put out a note. It might have been before President Trump confirmed that tariffs were going to move forward.
Yes.
And we saw this leg lower in the market in the afternoon. But, he pointed out the fact that today will be the 7th day in the last 8 sessions where the SPX closed below its open, and that they continue to see near-term downside risk to the 200-day moving average, which would be 57.23, and highlights the roles that semis are playing in all of this. So I do wonder how closely we need to be paying attention to some of these levels.
Well, once you start getting this sort of downside momentum and you get the intraday sell-offs, it does create the scenario for some kind of crescendo or an accelerant to kind of find exactly where you're going to get to sort of the high conviction buys. I always say that when the market gets more volatile, it means the price has to swing and move farther to find buyers and sellers who have conviction to move there. And when the sort of news flow and when the outlook is more unsettled, you have to actually see if those levels might hold. Not saying we're going to get there, but it's a logical next place to have in your mind as a potential stop.
Okay. Mike Santoli, see you again in just a little bit. Well, tech stocks getting crushed today with the NASDAQ falling more than 2.5%. Our Steve Kovac is following two of the big tech losers. Steve?
Yeah, John, that would be Microsoft and Apple. And look, we talk so much about the Canada and Mexico tariffs, but this is also China impact as well. So let's start with Apple, which closed down about 1.5% today. This is because of that additional 10% of tariffs that President Trump mentioned. This is going to bring the total up to 20%. Now, we know a couple weeks ago, Trump said he met with Apple CEO Tim Cook, presumably to talk about these tariffs. And last Monday, Apple announced that $500 billion investment in the United States. We'll see if that gives them the tariff relief they wanted. But right now, it looks like it's just going to be broad-based and so forth. But look, analysts said when those first round of tariffs, that 10% that went into effect a month ago in China, that would hit earnings by low single-digit percentage points. We'll have to see what they say for this round. I'm expecting a lot of analysis to come in tomorrow morning. But now let's go over to Microsoft, which took even worse than Apple, down about 2% closed today. Also, that China tariff impact. On the last earnings call, I'm going to point to some comments from CFO Amy Hood, who warned that Windows revenue could decline to the low to mid single digits because of what she called, quote, tariff uncertainties. Now, as you know this, John, most PCs are made in China, and some PC makers at that first round of China tariffs have already said they're going to need to raise prices. You can also see Dell and HP were off quite a bit as well, guys.
All right. Steve Kovac, thank you.
Thanks.
Small cap stocks getting crushed in today's sell-off, adding to their underperformance this year. The Russell 2000 touching its lowest level since September of last year, finished down more than 2.8% today. Let's bring in Greg Tuarto, Managing Director and Portfolio Manager at Goldman Sachs Asset Management. Greg, it's good to have you here on set. And that's exactly where I want to start. The fact that small caps have been underperforming. Obviously, we have this tariff news. We've seen the dollar weaken today in the midst of all the trade angst and growth scare concerns for the market as well. Do you buy here?
I think you have to. I think you have to start legging into small caps. It's been a number of years of underperformance. I think one of the largest, headwinds, especially over the last couple of years, was rates. That's out of the way right now, and I think that should be turned into a tailwind. The growth scare narrative is something that is, that we have to get through, but I do think it's a buy right here.
Why do you think the rates piece of it now turns into a tailwind? We know the Fed, at least for now, is sitting on its hands. Is it just because the bond market is actually sending yields lower?
Yes, and I do think that point of friction with small caps does tend to kind of hold people back at the index level. There's an old saw about small caps that they don't have the best balance sheets. They're exposed to floating rate debt. So the higher the rates are, it does impact their cost of borrowing. It hurts their cost of doing business. So I do think that generally speaking, it does kind of create a little bit more attention to what the end calculus could be for what the return should be.
Help me understand, Greg, why the pros in small caps in the medium term even outweigh the cons? Because I'm thinking of cons, you mentioned higher rates. I'm thinking they got less scale to absorb costs. Maybe they've got less budget to get into something like AI that could deliver some shorter term productivity enhancements, perhaps. But then they've got more domestic business, I suppose, on the, by and large. So they're going to perhaps be hit by some of these international effects less. But what else?
So I do think you hit some of the big ones, and I think that it's kind of a commercial for active management because you can stay inside the kind of color inside the lines of the companies that will be less impacted by some of those tariffs. When we look through our universe, the companies, some of the soft lines retailers, some semiconductor capital equipment companies may be impacted a little bit more from this new wave of tariffs we're seeing, but for the most part, I don't think that it's going to change the kind of the business plans that most of these CFOs laid out 6 months, 3 months ago. And in addition, if you look through sort of some of that domesticity that you just mentioned and what we talk about a lot, I still see the consumer as while they're saving a bit and weather has been tough for some of the restaurants year to date, I do think that there's a good demand picture as you go throughout the rest of the year.
But the working class consumer has been strapped. And one wonders, given how big an employer smaller businesses are, if tariffs have an impact on them and then it starts to inflect employment with a working class that's already stretched, what happens? Is that a danger for small caps in the economy?
It could be a risk factor. We haven't seen it or heard it from the companies who've just gone through an earnings season, a significant amount of earnings. You're not hearing that there's kind of any job cuts out there. As a matter of fact, most of the surveys we see from small cap executives are quite bullish, even through the last few weeks. So I do think that there's no real danger of job loss from the small cap companies. And I do think that if you start to think about the employment picture and, we kind of bring in some of the worries about, kind of federal jobs that are lost, I still think employment is pretty solid. And if people are employed, I do think that they will spend.
All right. Still looks good then. Greg, thank you. Greg Tuarto. Well, Okta earnings are out. Seema Modi has those numbers. Seema.
Hey, John, this is the security cloud provider that reported better than expected earnings, a 4-cent beat on its bottom line, revenue coming ahead of the average analyst estimate, and its first quarter guidance was also above Wall Street expectations. RPO, which is a measure of subscription backlog, was a standout. And amid this tough backdrop, worth noting, shares are up nearly 13.5%, 14%. JP Morgan did make the point going into this report that this specific company, and especially given the magnitude of hacks that we've been seeing in recent months, is well positioned in the security market. Stock again higher in overtime. John and Morgan.
All right, Seema, thank you. Coming up, Tesla pulling back after an early bounce attempt as the February weakness carries over into a new month. We will talk about how Tesla and other automakers could get hit by tariffs.
And analyst Dan Ives will join us with his take on NVIDIA, which fell more than 8.5% in the session. Overtime is back in 2.
Thank you.